Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Metlife Inc. Annual Report. Metlife Inc. offers a wide range of financial services to individuals and businesses worldwide. The company's insurance products include life, dental, group short and long-term disability, paid family and medical leave, individual disability, accidental death and dismemberment, accident and health, vision, and pet insurance. Additionally, Metlife provides prepaid legal plans, administrative services, only arrangements for employers, and general and separate account contracts. The company's asset management services include pension risk transfers, institutional income annuities, structured settlements, and capital markets investment products. Metlife also offers various types of annuities, such as fixed, index-linked, and variable annuities, as well as pension products, regular savings products, and whole and term life insurance. In addition to these services, Metlife provides protection against long-term health care services through its credit insurance products and accident and health products. The company also offers funding agreements for post-retirement benefits, as well as company-owned life insurance used to finance non-qualified benefit programs for executives. Unfortunately, I do not have access to the text you provided. However, I can provide a general essay on what may cause a stock price to remain stagnant over a period of time. The stability of Metlife Inc.'s stock price in the past year can be attributed to several factors. One possible reason is the company's consistent financial performance, which has led to investor confidence and reduced volatility in its stock price. Additionally, the insurance industry as a whole may have experienced a period of relative calm, with no major disruptions or changes that would significantly impact Metlife's operations. Another factor could be the lack of significant news or events affecting the company's prospects, such as mergers and acquisitions, regulatory changes, or major product launches. This absence of catalysts can contribute to a stable stock price, as investors may not have any compelling reasons to buy or sell the shares. Furthermore, Metlife's diversified business model, which includes life insurance, annuities, and employee benefits, may also be contributing to its stable stock price. The company's ability to generate steady revenue streams from these different segments can help reduce its dependence on any one particular market or product, making it less susceptible to significant fluctuations in its stock price. In conclusion, the stability of Metlife Inc.'s stock price over the past year is likely due to a combination of factors, including consistent financial performance, lack of significant news or events, and a diversified business model. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for various companies can be identified through a review of their financial reports. Revenue growth is often driven by increases in purchases of mortgage loans, accrued interest income from residential mortgage loans, and leased real estate investments. For instance, the purchase of mortgage loans increased by $2.8 billion, while accrued interest income rose by $32 million. On the other hand, revenue decline can be attributed to decreases in sales of mortgage loans, gross charge-offs of mortgage loans, and fixed maturity securities (AFS). The sales of mortgage loans decreased by $213 million, indicating a potential issue with loan sales. Additionally, the decrease in fixed maturity securities (AFS) by $100 million suggests a decline in investment returns. Other key drivers that may impact revenue growth or decline include changes in tax credits and capital loss carryforwards. For example, net operating loss carryforwards increased by $51 million, while tax credit carryforwards decreased by $107 million. These changes can have significant implications for companies' financial performance and should be carefully monitored. The fluctuations in net income and profit margins over the past 3 years have been significant. In 2023, net income was $1,380 billion, with a profit margin of 46.2%. However, this number increased by 130.8% to $4,226 billion in 2024, resulting in a substantial rise in profit margins to 95.1%. Conversely, the trend reversed in 2025, with net income decreasing by 24.6% to $3,173 billion and an unreported profit margin. The reasons behind these changes are multifaceted and not explicitly stated. Nevertheless, it is likely that shifts in revenue streams, expenses, and tax provisions have played a significant role. The potential for future charges to impact consolidated net income further underscores the complexity of these fluctuations. The company's financial performance indicates a strong ability to generate operating cash flow. According to various summaries, the company is expected to produce approximately $25 billion in free cash flow over a 5-year period. In 2024, the company generated an operating cash flow of $14.6 billion and had a net cash provided by operating activities of $2.84 billion. This trend continues into 2025, with a net cash provided by operating activities of $4.73 billion. The ratio of net cash provided by operating activities to consolidated net income is also impressive, reaching as high as 112% in 2024 and 90% in 2025. Furthermore, the company's operating cash flow status is consistently reported as positive across multiple summaries. While there are some conflicting reports indicating negative operating cash flow for specific years or scenarios, the majority of information suggests that the company is indeed generating positive operating cash flow. In conclusion, based on the available data and summaries, it appears that the company is successfully producing positive operating cash flow, which is a key indicator of financial health. The company's debt levels and interest expenses have undergone some notable changes over the past few years. In terms of interest expenses, there has been a significant increase in 2024 compared to 2023, with a jump from $1,037 million to $1,061 million. However, this trend is expected to reverse in 2025, with an estimated decrease to $968 million. Looking at the company's debt levels, we see that long-term debt has decreased by $432 million between 2024 and 2023. On the other hand, subordinated debt securities have increased significantly, rising by $991 million over the same period. Despite these fluctuations, the overall debt level is expected to decrease from $15,878 million in 2024 to $15,450 million in 2025. It's worth noting that while there are some variations in interest expenses and debt levels, the company's financial situation appears to be stabilizing. The expected decrease in interest expenses in 2025 suggests a potential reduction in borrowing costs, which could have a positive impact on the company's bottom line. The performance of various regions and segments within the company has been mixed. On a positive note, the Asia region saw an increase in net income by $0.1 billion and revenue by $0.3 billion. The Latin America region also experienced growth, with revenue increasing from $7,371 million to $8,304 million. Furthermore, the group segment reported revenue growth from $25,230 million to $26,881 million. However, some regions and segments struggled. The EMEA region saw a decline in net income by $0.1 billion and revenue by $0.7 billion. The RIS segment experienced a significant drop in revenue, falling from $16,635 million to $21,036 million. Additionally, the residential and agricultural segments performed poorly, with shares of 17.3% and 23.1% respectively. The closed block also faced issues due to potential deficiencies in assets and cash flows. Furthermore, distribution agreements acquired and customer relationships may have been impaired due to adverse changes in investment returns. Finally, products with guarantees may have increased liabilities if equity or fixed income funds decline or become more volatile. MetLife's management is optimistic about the company's outlook, citing a positive future with no material payments expected under certain guarantees or indemnities. The company is focused on growing through lending and investing, as evident from its commitment to providing funds for loans and investments. This growth-oriented strategy is supported by MetLife's strong financial position, which enables it to meet its obligations and maintain adequate capital levels in its subsidiaries. In terms of risk management, the company has taken steps to limit unsecured derivative liabilities and has a high-quality mortgage loan portfolio with minimal non-performing loans. However, MetLife also faces regulatory and tax challenges that may impact its strategy and outlook. Despite these challenges, the company's overall position remains strong, with management confident in its ability to navigate these issues and achieve its growth objectives. MetLife's commitment to maintaining a strong financial position is evident from its focus on managing risks and recovering value from commercial mortgage loans. The company's use of derivatives to manage interest rate risk, foreign currency exchange rate risk, and credit-related changes in value also demonstrates its proactive approach to risk management. Overall, MetLife's outlook appears positive, with the company well-positioned for growth and success in the future. The company has made several significant acquisitions and divestitures over the years. In terms of acquisitions, the company has acquired distribution agreements, value of business, and customer relationships through various investments. Specifically, it invested $490 million in investment funds in 2025 and $375 million in 2024. In addition to these financial investments, the company has also made strategic acquisitions that have contributed to its growth. However, the company has also engaged in divestitures, which involve selling off certain assets or businesses. One notable example is the spin-off of Brighthouse Financial, Inc. in 2017, where the company distributed shares of Brighthouse's common stock to its shareholders. The company has also reorganized its business through a strategic reorganization, transferring a product from one segment to another, and resulting in a loss of $165 million. This move was likely aimed at streamlining operations and improving efficiency. Overall, these acquisitions and divestitures have had a significant impact on the company's financials and operations. The company has a history of paying dividends to its shareholders. In 2025, the company paid out $944 million in dividends, while in 2024 it paid out $1.7 billion. The parent company, Metlife Inc., also paid dividends on common stock totaling $1.509 million in 2025 and $0 in 2024. Additionally, preferred stock dividends were mentioned as being paid. The company has also engaged in share buybacks to return value to its shareholders. In 2025, the company authorized a share buyback program of $3 billion, with $2.1 billion remaining at December 31, 2025. The company repurchased shares totaling 35,295,854 in 2025 and 43,955,023 in 2024. That concludes the financial summary for MetLife Inc. Feel free to comment below, and I will be happy to answer them when possible.